Good afternoon, ladies and gentlemen. My name is Ryan Suter. I'm one of the senior investment managers here at Sharewise, and we're here with Pioneer Credit Managing Director Keith John. Now, Keith has been kind enough to lend us his expertise surrounding Pioneer, as well as his time this afternoon to give us a presentation, which is going to update us on how Pioneer is tracking. And then, as always, we will open the floor up to a Q&A. Now, I've got a couple of questions that we'll start things off with after the presentation, but if any participants would like to submit questions for me to ask to Keith, please submit the Q&A function on Zoom and I will ask them afterwards. Now, Keith, it's all yours. Thank you very much for your time, mate.
Thanks, Ryan, and thanks to everyone for joining us today. One of the things I said to Ryan as we were talking before is that there's no questions off limits, so please, at the end, feel free to ask away. There's nothing that we're not prepared to address or answer for you. What we have in front of us today is a pre-results roadshow presentation that we did last week, and this was off the back of a refinancing that we completed at the end of June, which really sets this business up well for FY25 and beyond. So I'm going to take you through some numbers, some high-level numbers from FY24 ahead of our results, and then talk you through what our business is, the value that sits in our business, how we go about our business, and the investment opportunity that sits in front of you today. There is, of course, the important disclaimer, and importantly, just to call out that the figures that are presented in front of you today are from the company's management accounts. They are as yet audited, so they are not audited, and they are subject to change. So in terms of the highlights for FY24, there are four important aspects of our business that we've called out. The first is cash collection. So this is the amount of money that we receive into our business each year. That was $146 million last year, up 10% on the prior corresponding period. EBITDA grew by a little bit more than that, so really good cost management within our business, up to just shy of $97 million. The core assets that we buy, so these are called purchase debt portfolios. I'll talk about those in a moment. We invested just shy of $94 million last year into these assets. Really good growth on FY23 and a really nice pipeline for FY25 in front of us. And cost of service, this is about the efficiency of our business. How well do we operate? And over the past few years, we've worked really hard to bring that down from the mid-40s to the mid-30s. It's a really good number. It's the bottom of our target range for the next couple of years, and it's a range at which we're really profitable at. So we're really pleased with the performance and the efficiency of the way we're operating our business. Importantly, the other one major bit is we closed our senior refinance. I'll talk about that a bit more in a moment, but it saves us $8 million a financial year from FY25, and that drops straight to the bottom line. So that's a big saving that comes for the benefit of shareholders. In terms of Pioneer, what do we do? We're a debt recovery specialist that acquires and services retail finance portfolios. And by that, what we mean is we buy credit card predominantly and personal loan portfolios off the banks and the non-bank lenders. We bring them onto our balance sheet. We hold them for our benefit, and we work with those consumers over time to get them back paying. We do not do any work for any third parties. We don't do any commission-based work. We don't do anything in the payday sector or the SAC sector. So we're not focused on lower quality consumer segments. We're talking about the best quality consumers from the best quality institutions in Australia that have the highest propensity to cure. And that's where we focus. We're a leader in this market. This market has changed dramatically in the last 5 years, so much so that amongst the big banks, it really is a duopoly now, of which Pioneer is one half of. We're very proud of that. Since 2008, we've invested almost $750 million into these assets across almost $6 billion in receivables. And what that gives us is two things. One is a very, very solid history of performance, which you can see through our operational performance over time. And second, very deep data sets on which to do our underwriting. So the way that we go about investing our capital and your capital, if you're a shareholder of Pioneer, into these assets. And that's critically important to make sure we buy the assets at the right prices, to make sure we get the right economic outcome from them for all of us. We currently have an active portfolio of about 2 billion in receivables due to us. And of that 2 billion, about $440 million is under arrangement. So these are customers that are paying us weekly, fortnightly, or monthly. And it's a very predictable cash flow that comes into our business. It represents roughly half of our cash flow each year. And we'll talk a bit more about that in a moment. Finally, and this is critically important, long before ESG was anything in this country, Pioneer always talked about having good people, doing the right thing by customers, being a good business that was trying to get good outcomes. That has served us exceptionally well. And in an era of heightened consumer care and consumer advocacy, Pioneer stands out amongst all others as being the group that delivers that best. And that's one of the reasons why we're successful. A little bit further about the ESG parts of our business. Our purpose is simply to put an end to debt stress. We can't solve debt problems for people, but we can stop them worrying about it. The people that come to us are just like you and me. They're going about their daily lives, they're living their life, and they're going about it quite well. And then something happens. Death, divorce, sickness, domestic violence, might have lost their job. All of the things that we hear about. And our job is to help people through those situations. And if we can do that and we do it really, really well, then we'll get paid well. The customer will have less stress in their life. They'll have a good experience and be able to go and grow on their life as well. We have 3 principles across our business to which we guide everything. Be human. You know, our business is about dealing with people. We don't run call scripts. We're about solving problems when we speak to our customers. Choose integrity. We always do the right thing. Irrespective of what it means to this business, we do the right thing. And we act with purpose. When our people talk to our customers, we're there to solve problems for them. We're not there to put them into a tailspin and to create difficulty for them. We want to make it a really pleasant experience for those customers. If we do that, and again, we think we do that really well, that lowers our servicing costs, it lowers our compliance cost, it improves the customer experience, and that's really good for vendors selling debt to us. And our vision is simply to be the first choice. We want customers to choose to deal with us. We want vendors to choose to sell to us. We want people to work for us, and we want you to invest in us. That's what drives us. In terms of management, my management's been with me for a long time. They're critical to the success of the business, obviously. I founded this business a long time ago now and have over 30 years experience in financial services, all of it in the distressed debt space. Sue Simmons, my company secretary, has been with us for 8 or 9 years. She's really the conscience of our business, looks after our governance, oversees risk and internal audit, and all of the things that keep us tight and working well. Barry Hartnett, CFO, has been with us for 10 years. In addition to his finance responsibilities, has great relationships across the banking sector and the finance sector from which we source our product. And Andrea Hoskins, been with us for almost 5 years now. Andrea's responsible for running our operations. Our 400 odd people across our business ultimately report into Andrea, and she's responsible for making sure they come to work, we have enough people, they look after our customers appropriately, and we get a good outcome for them and for us. In terms of the portfolio, as I said at the outset, there are 2 billion in receivables due to us, and those receivables broadly fall into 2 categories. One is our WIP, our work in progress. So as we buy a new portfolio, it goes there, And those customers, some of them are new to business, some of them have been with us for a couple of years. And we're working with those customers to understand when they have capacity to pay. This is not a business that takes legal action lightly, or even has that as a real feature of our business. It's a business that works with customers. As we understand capacity, then they either pay us in lump sums, they might pay us sporadically, they might pay out in full, or they might go on an arrangement, go into our performing portfolio, which currently sits at about $440 million. Across that performing portfolio, there are a few features about it. One, a low cost to service. So it's a really efficient part of our business. Those customers are predominantly on direct debit, and they pay us periodically as per our agreement. So that's really good for the way we operate our business. They're very high quality. Over the last couple of years, that portfolio has been pretty static. And the reason it's been static is because as fast as we're writing new arrangements, customers are paying down their debt. So whilst we're seeing lots of cost of living pressure across the country reflected in retail sales and the type of product that people buy and where they spend their money, they're continuing to pay down debt. We're seeing that across the financial sector. So that's been really good for us. As I said, no payday in there. In FY25, at the outset of this year, we expect about $70 million to come from that portfolio. So that's $70 million in cash collections that's already booked in. So really, really healthy starting place for our business. And like I said, we generally get about 50% of our revenue from there and 50% from that with portfolio. In terms of customer outcomes and ESG, this is really important. This is how we sell our business. This is one of the ways we differentiate ourselves from others. Pioneer is the only purchaser of note that publishes a Net Promoter Score, which is how likely are you as a customer to refer us to your family and friends. It's an odd question to pose to someone when you think about debt recovery, but it's how confident we are in our service. Plus 19, it's a remarkable result across NPS. And you will see at first contact, just in the middle there, it's minus 46. So at minus 46, that's the day we buy the account from the vendor, from the bank or the financial institution, and we make first contact with them. So they've got a very negative outcome. And our job is to solve their stress, remember, is to help them, to relieve them of debt stress. And you can see we do that. When they start paying us, it's plus 13. Ongoing payers, plus 60, plus 35 for several payers. And that's really, really good and really healthy. It's one of the ways we demonstrate just how successful we are at the job that we do. In terms of the market in which we operate, fantastic market for us. It's been changing dramatically over the last few years. We've seen a contraction in the number of participants in this market, such that there are really two large ones now, us and another, and then there's a few smaller players that sit underneath us. That's been really good for Pioneer. We've got the scale, we can operate efficiently, we've got the balance sheet and the cash flow to go and invest and invest a lot of money across this sector. We have a 5-year agreement. We call them a forward flow agreement. So if you think about the way this might work, we have an agreement to buy all of the receivables that look like a certain type every 30 days from CBA for the next 5 years. We share that contract largely with one other, and that goes through to 27. That's a great part of our business. We have the best starting position in 6 years this year. $58 million of investment contracted on day one. Remember, we invested 94 last year, just under 100 a couple of years ago, and 60 the year before. So we start day one with really healthy pipeline of agreements in place across 13 vendors. We expect to grow that materially through the year. That's going to be really, really good for the health of this business and for the growth in revenue that we expect to come from this business. A market size of $325 million in FY24. We expect it to grow quite healthily in 25 to about $400 million, driven by the return of a large vendor that's been sitting out of the market for a while, but also by the backlog of debt that people have accumulated over the last few years that we expect to see released to the market. We have about a 25% market share on that basis, and a really good opportunity to grow our share. In terms of that growth, it's really important to understand why. How are we going to grow this market? Growing because you pay more is not a success. Growing because you have a better proposition for a vendor, that's what makes you successful, and that's what Pioneer has and has always had. We're one of the few scale participants in this sector. Really, really important. We generate a lot of free cash. Last year it was well over $65 million in investable cash out of that EBITDA. This year, with the saving that we expect or we will get from our refi, well over $70 million of investable cash. So that's really, really good. That's an equity investment back into the growth of this business, which we've got. We've got a market-leading reputation. We've always had that. We pride ourselves on it. People like it. We do not offer further credit. This is a big one because the sellers of this debt would prefer not to sell to someone that has a competing loan. They certainly don't want to sell to someone that has a payday loan like others in our sector do. And that's really, really good for us, particularly across the non-banks. And we've got a unique servicing approach. We're working with these customers over time. In terms of growth, there are a range of performing portfolios that are available for sale in the market, which we've been approached about. There are warehouse sales. I just spoke about the build-up of accounts over the last few years. They're available. There are M&A opportunities and opportunistic portfolio acquisitions in our market. There's a group in the press at the moment that's selling their portfolios. These are all really, really good opportunities for us. In addition to that, we have less competition because it's contracted markedly over the last few years, and we've got a really, really strong economy. The biggest swing factor in our business is employment. Do people have a job? And as you know, almost everyone in Australia has a job, and that's really good for the health of our business. I talked about the senior refinance. This is what it looks like in front of you. But in short, we've got a new facility of $272 million drawn to $222 million. It's been led by Nomura. Nomura have funded us twice before. They are also a substantial shareholder in the company. So they're very aligned to us. Standard covenant package, we're paying a margin of 5.5% with a 4-year maturity. That package will save us $8 million this year. It's a great big benefit to the bottom line, obviously, and that will be really good for us and allow us to increase our profits markedly this year and next. And it will also allow us to pay down some debt, decrease leverage, and further increase our profits into the future. There's a big balance sheet focus in FY25. We want to get rid of our medium-term notes. We need to start on that in FY25, and we expect to pay down a separate SPV of $16.6 million. We paid off $8 million in the half. We expect that to be finalised by June 25. So really improving financial metrics right across our business. And finally, the most important part, I think, for you is our alignment to shareholders. You want to be invested in a business where management is sitting alongside you, is incentivized to get the right outcomes for you. Management's the largest shareholder in this business. I own 13% of it. Management owns another couple of percent of it. Samuel Terry Asset Management came onto the register recently. They own 16%. James Simpson, who's been with us for a long time, very supportive shareholder, ex-founder of Platinum Asset Management, Kier Nielsen. He's at 8%, and Nomura at 7%. Really great bunch of shareholders that have been with us for a while. Samuel Terry are a new fund to the business, and we're very, very happy to have them on board. Importantly for you is our incentivization. And that old adage, show me the incentive and I'll show you the outcome. Never more could be true. In Pioneer, no manager or executive ever gets a short-term incentive. We get a base salary and we get a long-term incentive. That long-term incentive is literally over 3 years. So we have 3 yearly targets, FY23, 24 and 25. And assuming each or some of those are met, those incentives roll forward to FY26 and are only paid if we hit FY26. So next financial year, we must deliver a statutory net profit after taxation of at least $18 million. If we do, management incentives are paid out, and if we don't, they are not. It's as simple as that. So management has 4 years worth of work, all resting on delivering on next year's number, which I can promise you they are working relentlessly to deliver upon and expect to deliver upon. Those incentives are paid in shares. So again, they're sitting alongside you with equity invested alongside you in the business. Finally, strategy. We've just had a couple of days setting up our 3-year strategy with the board in April. We had a day with external advisors coming in, challenging our thinking, really different people with different thought to us, an economist, a debt player, a market player, a debt advisor, technology, all driving at what we do. There are 3 key themes that are coming from our strategy. One is to optimize and grow customer outcomes. Sounds like BAU. It's actually a big work stream across our business, including uplifting the customer experience through our customer portal, building out our brand awareness and trust, and building on that. Driving operational efficiencies. There's a lot of automation to be brought into this business, and to start driving down that cost to serve. If we can get that down further, that means a better outcome for our shareholders. The other side of that is, how do we operationalize this business so we can work with more customers in a more efficient manner? And that's about enhancing our capability, delivering on a core system replacement, uplifting our data so that we can process data more effectively. That $750 million we've invested, how do we leverage that data more so we can deliver better customer outcomes in a more efficient manner? And that program of work, which is led by Andrea Hoskins, our Chief Operating Officer, is well underway. And finally, what's our focus for 25? There are 5 key things. There are strong tailwinds for us in this sector. There's significant supply of portfolios for us to buy. And as I said, we've got our best start to a financial year in over 6 years, $58 million under contract. It's up 2/3 on where we were at this time last year. Cheaper funding is now locked in. We've got a facility with growth capacity attached to it, the ability to upsize it in the future, and plenty of opportunity to continue to decrease the cost of funds inside that balance sheet. There is continued regulatory focus in this sector that's really good for a best-in-class player like Pioneer, and driving that, making sure we're ahead of the curve, making sure we respect the law, and driving a great NPS and customer experience. Realising operational leverage, key to our business as well. Driving down costs and driving efficiency through our business over the next few years. And importantly, you've got tested and experienced management. I lead the business as a founder. We've got executives with extensive experience across the sector, but in this business as well, and an LTI, management incentives, that are aligned to you, vest on achievement next year of delivering a net profit after tax of at least $18 million. Ryan, that concludes my presentation. Happy to take questions from any of your participants.
Thank you very much, Keith. Absolutely brilliant presentation. I'll just kick it off with a couple that I've got here, and then we'll shift to some participant questions. Once again, if you'd like me to ask anything to Keith, please just submit the question through the Q&A function on Zoom. Now, obviously, Keith, you guys have had a very, very exceptionally busy 12 months at Pioneer. Now, with a really strong turnaround in your financial performance, which can be reflected through a bit of growth in the share price, as well as completing a $10 million equity raise, which is currently at a premium to the market. You've also signed, the $4 million senior finance facility agreement, which looks very attractive currently. What I'm interested in, though, is what's Pioneer currently doing in the sphere to attract such strong support?
Thanks, Ryan. Look, I think there's a range of things. One is, this is a business that had a couple of really tough years through COVID. It's a business that stands up with integrity right back to our principles at the beginning and is always front and center with investors. And as investors have heard our story, continue to see us prove that up over time and time again, the belief in our future and the understanding of our future is there, and that's what's attracting the support. The other part, of course, is we're aligned to shareholders, and credit investors think like shareholders. They want people that are there for the long term, driving the right long-term outcome. So if I talk about the way we invest money, in our business, we have an investment committee. There are the 4 executives that sit on it. If one person says no, we don't do it. This is a business where everyone has to be aligned, everyone has to be on board. And if we're not, then we don't do something because that person cares deeply about us. And if they've got a concern, we should have it. And that's what people like to see. They like to see that we're all aligned, all pushing in the same direction, and we've got the right amount of tension in our room. We've got risk people, we've got financial people, we've got operational people driving at the right outcomes. And I think that's serving us very, very well and being well understood now by equity markets.
Well, I really appreciate the update and clarification in that regard. Now, obviously, with the new senior finance facility, it does include the $50 million headroom. Now, obviously, it doesn't appear that you've withdrawn from that yet. What are the plans for those funds?
Yeah. So, look, as I said during the presentation, we've got somewhere in the vicinity of $75 million of free cash expected from this business this year that's investable. We will, we've got much greater capacity to buy this year. So if we were to spend in a similar vein to like FY24, $100 million, we're going to need to draw down about half of that facility to do that. But that's fine. That's really good. That's what it's there for. And if we think about that in the contribution of 75% equity, 25% debt, that'll help us deleverage as well. And that helps us with our cost of funds and that so forth. So look, we haven't drawn down on it yet. There's great opportunities for us. We need to make sure we realise those opportunities first before we draw down on that. But we expect that'll start occurring this year.
Okay. Appreciate the update there. Now, realistically, between now and for the rest of the calendar year, what can investors expect from Pioneer?
Yeah, I think there's a few things, Ryan. So first of all, our results are out at the end of August. We'll provide some guidance then, some updated investment guidance. In all likelihood, provide some guidance around what you should expect from NPAT and so forth. A lot of that's telegraphed to the market now, and with the $8 million savings, the market's got a fair understanding of where we're heading. So that's the first bit. We think there are a range of opportunities that will come through the market over the course of the next year, and we expect to be able to update the market on that a bit more regularly than we might have in the past, as this market's becoming a bit more dynamic for us now.
Okay. Now, just to pivot to a more macroeconomic focus, can you talk us through the current state of the debt portfolio market and realistically why Pioneer, when compared to its competitors, is seeing growth opportunities?
Yeah. So I think there's a range of things that have happened. The first is going back 5 or 6 years ago, this market was really split between sort of 5, maybe 6 larger players, and then a broad range of smaller players that sat underneath them. But what was very, very clear, and it's why Pioneer has been so focused on this through its journey, and if you look at our old presentations, we talk about customer treatment as far back as 2014. Why we've been focused on it is it's clear. If you deliver a good outcome to consumers, you're going to do well as your business. And if you don't, then you're going to have pressures. And I think we've seen that across the journey. So we've had a range of participants that have left because of compliance issues. And then the other issue is we've had a range of participants that have got in trouble because they've simply paid too much for the debt. Okay, they haven't got the return. And that's because incentivization is wrong and they've gone by the wayside. So there's 2 parts to this. The first is we've got this contracting market because people have got it wrong on the other side. This is a very healthy market. Pioneer's got a very, very healthy position. It's hard to see any significant competition in the next sort of 18 to 24 months. A bit hard to focus beyond that, but we're going to get it in time, of course, but we've got a pretty clear runway. And then the second is our alignment to the vendors. Back to if you're a non-bank lender and there's been a proliferation of them over the course of the last few years, and you're selling debt into this market, you do not want to sell it to someone that isn't aligned to you. You don't want to sell it to someone that is selling payday loans. And Pioneer doesn't, and that's really good. They trust us to look after these customers, to get good outcomes and to protect their brand. And that's why we're so successful in what we're doing. The real thing for us that we've got to focus on, we've got to remain focused on, it's all very good and well investing money. You've got to be able to operationalize it. So whilst there is the opportunity for us to spend materially more than $100 million in a year, it won't happen this year or it's unlikely to happen this year because we need to be able to look after those customers properly through the journey. So this is a growth business with really good growth ahead of us and great opportunity that sits outside of that as well.
Well, it's really positive news and really strong to see an update. Now, again, so obviously past 2 years, 13 interest rate rises, cost of living pressures appears to be, the headline in every other news article. Collectively, you guys have over 250K customers across Australia. Realistically, how is the customer base faring?
Yeah, I think the challenge for us around this, we hear the RBA and previous leaders of the RBA talk about how they're in touch with the consumer, and we don't see it. We're talking to the everyday Australian, and by that they are everyone. There's doctors and lawyers and professionals in there. There are tradies in there. There are single parents. There's the whole melting pot of the Australian population. There are great people, but they're struggling. They have changed their spending habits. They're not buying lamb now because it's too expensive. They're not buying steak because it's too expensive. They've downgraded the present they're buying their child. These are not things anyone wants to hear. What they are doing is they're fully employed and they want their families to get ahead, which is why they're paying down debt. So there's this element of parts of it are struggling, of the economy are struggling a lot, and it's a really real problem. And it's a lot of what we share with our customers. And then there's this strong desire to pay down debt. So whilst employment remains really, really high, and there are no forecasts to see that changing, that's really helpful for our business. But it would be nice to see that cost of living relief through interest rate decreases and the decrease in inflation so that people can get back to living the way that we all want to live. We don't want to go to the supermarket and have to make a choice based on price for staple items. We want to be able to choose what we want, and there's no reason why that shouldn't be occurring in this country. But really, really good for us, but really challenging for our consumers.
Of course. Really appreciate those market insights. Now we'll just pivot now to some participant submitted questions. First one here I've got is: are all of your IT and process upgrades now complete? What savings will those improvements create?
Yeah, so IT remains a work in progress. I think for everyone, our infrastructure is hosted. We've spent an incredible amount of money, just like everyone, on continuing to uplift cyber and data governance and those sorts of things. Whilst the bulk of the spend on that's complete, it remains an area we need to continue to invest in. In terms of our core platform and that work, we expect to complete that by the end of 2025, and that's all on time and on budget. Everything else looking really, really healthy. We have not forecast any savings into any outlooks across our business at this stage. I think the prudent thing to do is to bring that into our business, let things settle, take time to really understand how these new platforms work, where the opportunities exist, and extract benefit over time. Once we've done that, then we'll start sharing with the business, with our shareholders what that means. But clearly, we're doing it for a couple of reasons. One is uplift in compliance. This is a best-in-class system that will remove detective controls and have preventative type controls in place. So we're at the forefront of our compliance obligations rather than from a detective level, which is pretty standard in Australia in our sector. That's one. The second is the efficiency for our people. How do we make them more efficient so that they can solve problems more quickly and solve more problems more quickly? So that's a big part. And the third is our ability to operationalize data in a more efficient way and in a way that we better understand the consumer. Because if we can only talk to those consumers with capacity and desire, rather than those consumers without capacity where we don't want to be adding to stress, that's going to be good for our business. It's going to be good for our brand, good for those customers as well. So a lot of work to be done, but we're very happy with progress and expect some real benefits, but not in the current year.
Okay. Appreciate the update on that one. Now, that's the last question I've got here for the day is how much of the 16 million statutory profit in financial year 26 do you believe will come from the realisation of tax assets?
Oh, look, we're expecting to deliver on this operationally, Ryan. So that's the commitment. That's what we're working towards. We've got a really, really good business, really good operations. Great cash collections, revenue, and EBITDA, and that's we expect to deliver that operationally.
Well, thank you for that clarification. Now, Keith, before we wrap everything up, is there anything else you'd like to add?
No, look, I think that covers it. I really appreciate your time, Ryan, and the time of and the question from your subscribers. As I say to everyone, if you've got anything after this that you think of, please feel free to reach out to us, and we'd be more than happy to answer them for you.
Well, thank you very much for your time, Keith, and thank you very much, Pioneer Credit, for the opportunity. Ladies and gentlemen, enjoy the rest of your day. Cheers.
Thank you.